Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. We also have David Llewellyn Smith, co-author of The Great Crash of 2008 with Ross Garneau, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy, and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to this week's instalment of Nucleus Investment Insights, and we've called this one Volatility Explosion. I hope you'll pardon the picture there for those that are watching, but we thought we'd, I guess, in a way, encapsulate some of the major market movements that we've seen over the last week, and it's been reflected through, I'm sure, in a few people's portfolios. We'll jump into the agenda today. So we're going to kick off with rising long-term rates these are obviously drivers for the volatility. We're going to look at some trading issues. We're going to reflect back on last week's presentation on the Cold War 2.0. We'll then have a look into China and Europe slowing. Then wind into some fundamentals and valuations, and then of course, as always, wrap it up in some investment thoughts on how we operate our portfolios every day at Nucleus Wealth, and also how, of course, to position your portfolio. So I'll welcome the gentleman sitting across from me. So we've got our chief strategist, David Llewellyn Smith. Hello, David.
Hi, Tim.
And our head of investments, Damien Klassen. G'day, Damien.
Hi, Tim.
I'm sure you guys have been kept very busy in the last 7 days or so, given everything that's been going on.
Yes, we have.
Excellent.
I think, as we spoke about last week, I think we're sort of positioned for some of these moves already, and then but a lot of the issue was then as the markets fell, is just trying to work through the shopping list of companies we had, because I think one of the things we spoke about was that when you do get this volatility, often what happens at the start is people sell the most liquid names, and especially the traders, because that's what they're in. Mm-hmm. And so so what you often find is some of the better quality stocks actually fall at the start, and then but by the end of the whole process, they've risen it back again, and then you go through the lower liquidity names fall a little bit later. And so we've sort of been trading up a little bit in terms of some of the quality in some of our portfolio, just a little bit of repositioning.
Yep. Okay.
Around the edges.
Yeah, sure. All right, very good. So I guess let's jump into the volatility explosion theme and kick us off with rising US interest rates. So we've got a year-to-date chart up here.
Yeah. So the key one for the interest rates is that there's been that's sort of been fingered as the primary culprit, and you look at the year to date, and it's sort of rising from 2.4 to 3.2%, and so it's a pretty sort of in percent of percent, you could say it's a 33% rise in the interest rate. It's not quite as dramatic as that in big picture terms though, and because if you look at sort of a longer term perspective, which is what we've got on the next chart, you can sort of see that the current move is it's noticeable on the chart, but in the big picture of the long-term trend, it's still just sort of a bit of a blip on the radar. And so I think for our part, it's certainly an issue with the long-term rates, but the big issue is whether it's rates rising because the economy is going strongly and that we're going to see that inflation's higher and things like that, or whether it's I guess a bull steepening, as you'd call it, or whether it's more of a bear steepening, which I might punt across to David to talk about the difference.
Well, so yes, I mean we do think that this was the key to the resurgence in volatility, and one of the reasons we think that is because ever since the taper tantrum of 2013, whenever there's been a decent kind of rise in bond yields in the US, it's been followed by some volatility in stocks. And that's been working more or less like clockwork. It's kind of what you'd expect to happen. And so, the recent jump, which was to some extent tracking oil, and its recent jump on geopolitics, was a pretty clear signal to the equity market. So in terms of what's happened, what we've got there is just yields. If you actually look at the yield curve, which is how various premiums are playing out across time, there was a steepening, which as Damo says could either be bullish or bearish, but it's typically associated with stronger growth. If you look at the split, the sectoral split in the S&P 500 and what sold and what didn't, it looked like the equity market was positioning for a bear steepening. That is, it was selling cyclicals and interest rate sensitive sectors.
It did the best.
Did the best.
So we'll get that in a chart a little bit later, but it's the point that if it was all about rising interest rates and people were worried that interest rates were going to keep shooting up, then what you would expect is stocks like utilities and REITs would be the worst performers in the market, whereas they were actually the best performers in terms of the market, which is a question about whether people were actually concerned that the Fed was going to the Fed was going to raise rates too quickly, and that was going to stamp out the growth, and so you actually wanted to be in the safe sectors because the growth stocks were just about to get smashed by the Fed.
Yeah, that's right. And I mean, whether or not this volatility or selling is over for now, we don't really know. But I mean, the Fed added more grist for that mill last night when the last Fed minutes came out, and it was still quite hawkish. Based largely around, obviously Trump stimulus, but the really tight US labour market, which we saw this week in the JOLTS report as well, which is job openings, which hit I think a record high versus available labour, especially in the south of the US, which is where Trump is very strong, so that will do him no harm. And so, the Fed's very focused on a possible breakout in wages and wage push inflation. And last night, it was not panic by any means, but they're definitely committed to ongoing gradual rises, which to date has been sort of one hike per quarter. The equity market kind of adjusted to that relatively well last night, so that might be some indication that already the jump in rates has been absorbed by equities, and that has been the pattern since 2013. You get a jump in yields, which kind of recalibrates a lot of the models that equity investors are working on. It takes a while to absorb that, and then you get a period of diminishing volatility as we persists without rates kind of blowing off. My view is that we are still going to see steady rises in US wages. We've also obviously got some protectionism arriving now, and there'll be some price rises associated with that. But I still don't see US inflation tearing away, and nor do I see bond yields ripping off either. And one of the reasons for that is when you get these really quick moves in rates, you get a relatively quick response in the equity market, which kind of puts a lid on them, and they sort of push back and forth in this manner as the whole cycle pushes higher. So I'm not spooked at this stage, and it still looks like US growth is really good. And we still have, our fiscal cliff coming up mid next year, which will weigh on everything. And the equity market kind of.
And what David's talked about there is the tax cuts are also rolling off, and so the in terms of growth rates, the growth stimulus to the US economy is taking a step back.
Yeah. So there is still that, in the offing where we'll see slowing growth and new kind of deflationary forces coming to bear on the US economy as well. So I don't think US rates are about to tear through the roof, but it's still in very good shape.
Okay, very good. No problems. So that was 10-year Treasury, US Treasuries. We'll roll into some corporate debt divergence. So we've got here a chart, and we might just explain it for those listening in podcast.
So what I've got, just to sort of put things into perspective, and this is where the fears come from, and why we see the market sort of are very jumpy. So we know they're close to the end of the cycle, and it's people know they want to get out before the cycle ends, and so that's where you get these events and yields spike higher, and people say, is it the end of the cycle? Now I've got to clear out of equities before it's too late.
Yep.
And so a lot of that, it comes back to this corporate debt. And what I've got is a chart up there that's just showing the corporate debt as a percentage of US GDP. And that sort of goes through these big cycles. So it sort of cycles between sort of the mid 30s and the high and the mid 40s in terms of percent of the economy, and that's at a cyclical peak. It's as high as it's been at any time in the last sort of 20-30 years. And then on the other side we have the default rate that you get, and so
that's the green line on the chart.
Yeah, the green line on the chart. And so what that's and there's a correlation between the two, where the debt all builds up, and as the debt's building up, the default's quite low, and then you hit the peak of the cycle, and then the defaults all of a sudden start to rise, and then the whole thing rolls over into recession, and lending slows down, and the default, and then you're off into the next cycle.
Sure,
and so at the moment we've had this huge rise in the debt side. So we've got all this dry tinder sitting waiting to be lit, and the question is, is there a spark that's going to light this? And all of a sudden we get a wave of corporate defaults, and the cycle comes to a crashing end, and banks stop lending, and there's all that type of that's that whole cycle, and that's where and that's why everyone's so jumpy is because it's saying, well, we know we're close to the end of the cycle, and is it here yet? And the answer we think is still no. We're not here yet. We're close, so you need to be conservative. But the are we there yet question is still no. We're not there yet.
Okay, all right, very good. Anything to add on that one, David?
No, I suppose it's just interesting to mull why that gap is so wide between such high debt and such low default rates. It's hard to put your finger on, the whole thing. But I mean, the one thing you have to, I guess, point to first of all is just the US running these huge fiscal deficits through the tax cuts.
Yeah.
And it's just provided kind of artificial support for this debt load.
But low interest rates would be the first part of it. We had a little bit of a spike up there a couple of years ago, which was the oil
crash.
Yeah, so that was mostly based in one sector.
Okay.
So low interest rates has been a big part of it, and then the tax cuts. So the company tax cuts has certainly helped in terms of just having more cash available to pay down debt and to fund.
Or to ramp up debt and do buybacks.
Yeah, that's right. Well, and that's partly why I guess we have seen it sort of spiking up is. And people using buybacks as sort of as a method to increase the debt when instead of going out and buying something to increase your debt, you just use your buyback to buy back.
So when you say that, you're effectively using corporate debt to buy your own stock.
Yeah. So actually, so I should put that into perspective. So let's say you are let's say you've got $80 of equity and $20 of debt, and you're looking at your whole corporate capital structure and saying, well, I'd actually like to have a little bit more debt because the interest rates are still low and we're growing and all that type of stuff. Like, I can't find anything I quite want to buy at the moment. So the best way to get my debt, to increase my debt, is actually to go and buy back, $5 of my equity. And so now I've only got $75 worth of equity versus $20 worth of debt. And now, so I've increased the leverage within the firm by, not by actually increasing the debt, but by reducing the equity side of it.
And so I guess essentially the danger there is that the equity can fall, but the debt remains the same.
Yes. Oh, yeah, absolutely.
And of course, you've increased the value of your stock options at that point as well.
Oh, absolutely. Yeah,
and bonuses.
That's right. And so, and so, some of the companies have been lending at incredibly low rates, and it also and that's true in Europe as well as in the US. So, there's certainly a number of companies putting out very, very long-term debt at rates that are just head scratching in terms of. I think there's some utilities in Europe that are putting away, long-term debt at sort of similar rates to governments, and so
fascinating.
There's sort of a few sort of question marks on these deals. Will certainly come back to later, and covenants coverage, which is always a bit of another concern, is that's not particularly strong at the moment. So that's basically saying when you get to the debt holders, the things they want from lenders before they give out the cash, and at the moment. The whip hand is with the people giving out the cash, and they tend. Oh, sorry, the people, the actual people who are recipients of the companies. They don't have to put away too much in terms of the terms of the debt. They're not giving away too much.
Okay, sure thing. We'll roll into the sector rotation. We might just, it's a reasonably busy chart you've chucked up here, so we might just need to run through it.
And we've actually sort of run through that. That was just what we were talking about a little bit earlier. I've just got a chart showing there that since just in the month to date, in terms of the performance, utilities is sort of the only sector that's above zero, and as you move your way down the list of sectors, you're pretty much going from your most interest rate sensitive to your least interest rate sensitive sectors as you sort of go down the list. So you sort of utilities and consumer staples and REITs are in there as well. And so, it's just making that point that if this truly was a concern about higher interest rates, as opposed to a concern about the Fed actually stomping out growth, then you'd expect the reverse to be happening.
And just one thing to note on that one was, I can see here, clearly the second best sector there would be consumer staples. Has that been something we've been focusing on in what we're investing in, or is that sort of play into that?
Yeah, so we've spoken a lot about our positioning being sort of a barbellish type approach, where we're trying to keep an exposure to some of the higher growth sectors on one end, and then staples on the other side to sort of balance out the performance, and that's worked quite well for us. And we did a little bit of switching, not heaps, but a little bit of switching sort of as from staples back into some of the higher growth ones sort of over the last, as was market sort of bottoming out, just to take advantage of some of the cheaper prices you could pick up.
Okay, yeah, sure. Anything on the sector rotation there, David?
No, basically Damo's got it right there.
Okay, sure thing. We'll zoom into some trading parameters. So
that was one of the trading parameters. These are some of the other ones that have sort of been fingered as possible perpetrators of the volatility. And the question is, are they perpetrators or are they witnesses? So risk parity and the short vol complex get a bit here. Now what these guys are doing is effectively leveraging up their bond positions. So the idea with risk parity is that bonds are a lot less risky than equities, and so if you're putting up together a portfolio, you can actually leverage up some of your bond positions to increase the volatility in those to try and give yourself some parity in terms of what you're taking. So you take on a little bit less equity risk, but you take on more bonds, and you leverage them up.
And just on that, so just given obviously what's happened over the last week with bond yields, for example, so obviously bonds being the typical go-to defensive asset. What actually was it? Did it play out in terms of was it actually a run to safety, or how did bond yields go?
Yeah, bond yields initially were down, but since then, actually they bounce around.
Yeah.
They're sort of you haven't lost a whole lot on your bonds, I guess. If you're worried about if you're playing leveraged positions in these, then yes, you can make and lose a fair bit of money on bonds.
Yep.
But the reality is, from we're looking at some numbers just last week when we were looking at the bond performance over that time frame, and I think bonds were down maybe 0.1% or something like that. You might have lost over the week, whereas equities were down sort of 5 or 6.
Oh, yeah.
And so it's chalk and cheese. Like the bonds weren't up on it, so you weren't getting a negative correlation, but they certainly weren't falling at great rates.
So there's next to no correlation essentially, or.
Yeah, you probably they were positively correlated, then they were negatively correlated. So you could probably say that it probably ended up around zero. I think
Yep.
you sort of got a little bit of each way.
Okay.
But I guess the thing to note for risk parity is a longer term strategic position usually, and so it is run a lot by sort of some of the quant models. But the idea is that what will be happening in that is unlikely to be playing out over a week. It's more likely to be playing out over a couple of months. So as the volatility increases, these guys will be winding back their positions, but for the most part, they're doing their trades on a monthly or a quarterly basis. And so quite possibly it was due to some of these guys trading, but it wasn't them trading because of the market falling in the week. It was them trading because they were looking at the volatility over the previous quarter or the previous month and saying, oh, well, they've increased a little bit, so we need to wind back some of our positions.
Sure. Yep.
So that's a longer term game. The short vol guys certainly would have, but I think that mostly got flushed out. Back at the start of the year, when we saw the volatility there, which was largely around that short volatility.
Okay.
The CTA positions, that's probably more of a bigger issue for the markets. Now what
Might just need to define the CTA. Yep, sure.
Commodity trading advisors.
Okay.
So basically these are it's a US term, but basically it's people trading in futures, and a lot of them run sort of these momentum type and pretty similar models. And so the question for these is, when they all try to get for the exit, do they all they all go at the same time because they're all running off these momentum things, and so the momentum terms, and then all of a sudden they all have to jump out, and then the momentum flips back again, and then they're all piling back in again. And there's certainly some evidence that they've been involved, but again, it's not a it's relative. It's a medium influence. It's most likely it's unlikely to be the primary cause or the only cause of the volatility.
Okay.
And a lot of them, they're sort of a slightly lagging indicator rather than they might make the downturns a bit worse.
Yep.
But yeah, rather than. And then the final one I just wanted to note as well is that there's this longer term, or certainly this year, there's this value momentum issue in terms of the quant land, and we're going to go in a little bit more detail into that next week. Just looking at that whole strategy. AQR, which is sort of one of the world's largest quant managers, is sort of very high profile, and they've had a very tough time over the past year, also running these strategies, which in the longer term have worked quite well. In the medium term, haven't been as good, and there's certainly there's a number of question marks. And AQR in particular have been out very much on the front foot, explaining to people that you just need to believe, and this thing will eventually come good, and they always do. But there's certainly getting some doubt in that area, and the questions. The poor performance is sort of leading to quite money flowing out of that sector, and that might be affecting it's a little bit circular in the nature as money flows out of those strategies. That those strategies then have to sell their existing positions, which then makes those existing positions worse, and
off she goes.
Off you go.
Yeah. Okay. No problems. All right. Very good. We'll jump across into and this is just a quick slide from last week's presentation, the Cold War 2.0 between Trump and China, America and China. So we've got a list here of the factors or the scenarios that can increasing in risk, I guess, and of outcome in the Cold War.
So we spent a long time on this last week. So I guess if you're interested in more on the Cold War 2.0, probably I'll point you to that. But David will give you a quick rundown of.
Yeah, well, I mean, this formed the backdrop as well to the rise in vol, which is just a rising risk. As you can see on our list there, there's a kind of slippery slope of measures that the US and China could take against one another. The important point to note is that in roughly 2 weeks ago, prior to the volatility, the US effectively declared Cold War on China via its Vice President, Mike Pence. And so, this was a context of rising risk. And there is, a direct conduit from that to US Treasuries as well, like the rising yields insofar as what we mentioned before, that is, tariffs are inflationary. So, there's that dimension of it. Basically day by day, this thing is intensifying. We've got, new moves today with the US pulling out of a postal agreement, or planning to, with China, which is what enables China to send small parcels to the US very cheaply. And so it's just this drip, drip, drip of rising risk on Cold War 2.0. At this point, we don't think it's overly negative for the US economy, so probably, if anything, might add to growth a little. The consensus out there is that it's going to damage growth. We're not quite so sure. There's already evidence that the areas where Trump has applied tariffs, the imports are down quite strongly. And so there's two ways of reading that. Either the firms have been forced to cancel those orders because the input prices are now too high to make their products in the US, or they're going to divert that production to other economies, cheaper economies, or back home to the US. And we just think that there'll be enough of the latter for it not to be especially damaging.
Right.
Yep.
So if it adds a little bit of growth at the margin, again, in a very strong US labour market, that's again a little bit inflationary. And so for the time being, we're not overly concerned about it, I guess is the major point. But long term, it definitely has the scope to become quite disruptive if it turns really sour. Excuse me. So if you want to swing to the next chart, the other major factor that's been kind of troubling the market over the last few weeks, there are two more really. One is, China's slowing to some extent because of the Cold War 2.0, because all of these products that aren't flowing into the US anymore are all coming from China, or not coming from China, more to the point. And that's, quite a developing headwind that's only going to get worse. And on top of that, we had Chinese credit growth out yesterday, or last night, and it's also slowing still quite sharply. So, the composition of that is important in that it's shadow banking that's falling away, while there are some other stimulatory stuff in bonds and building that are already kind of ramping up as an offset. So I don't see Chinese growth kind of collapsing or anything next year, but we've got this mix of Chinese stimulus and building headwinds in its trade account. That mean it's certainly not going to accelerate much. If anything, it's probably going to keep slowing as it has been over the last kind of 12 months. And so that's now another worry for markets, just how quickly China slows, or the composition of its growth changes. It's definitely going to slow in the manufacturing sector, but is there enough building to offset that? And you can kind of see the way that that's playing out already with the commodities, some of them rising, some of them are falling. So, things like the base metals or the industrial metals have been coming off, but the bulk commodities, which are based very much just on Chinese, kind of mindless construction of bridges and apartments and, the usual story, they've all been going through the roof. So, there's a bit of a compositional kind of swing in there as well. And then the third, we don't have a chart for this one, but the third dimension of concern for the markets is Europe, and Europe's been slowing, steadily, or off its boom from earlier this year, or culminated earlier this year, and that appears to have, pretty steady momentum as well. That slowdown, like the German ZEW is coming off, at a pretty good clip.
Mm-hmm.
It's one of the best leading indicators in all of Europe. And then overhanging that, of course, you've got Italy, which is kind of in this death struggle with Brussels over its budget.
Mm-hmm.
They're arguing over very small decimal points in terms of how big a deficit Italy should run at this point, and it looks like they should be able to get a deal over the line, but it's just another thing that's been concerning the market. And
our take on that one is that Brussels is basically saying, when somebody asks for more money, more than what they're meant to have, is if you give it to them too easily, then they'll just be back to ask for even more next time. So they need to put up enough of a fight to try and convince them to show some more
change
more
their ways.
restraint.
Yeah, sure.
I mean, at this stage, though, we're talking something. I think the split between them is 2.4% deficit to 2.2, something like that, or the respective positions. So they really are quibbling
measurement error
at this point. And they also have to sort of go through this theatre, as Damo's described it, because May is the European parliamentary elections, and both sides kind of want to appear to be delivering to their bases. And I suspect there's going to be a rather nasty shock for Europe come May, with more Eurosceptics in the Parliament. But anyway, that's by the by. And so, there are these range of rather large macro risks, lurking behind the rise in volatility as well.
Okay, all right, very good. And we'll jump into the fundamentals and valuation sort of side of today. And we've got a chart up here of US earnings per share, EPS forecasts over time.
Yep, so both EPS actuals and EPS forecast for the US market. Now, the key thing we've been talking about for a little while is that it's very hard to have a solid market pullback and a consistent market pullback while earnings keep rising swiftly.
Right, yep.
And we're still in this phase of US 12-month forward earnings rising quite quickly. Now, we're going into the third quarter reporting season at the moment. That sort of just started in the last couple of days, and will really take off sort of in about 2 weeks' time. We'll sort of hit peak of that cycle. So we're in the point where we really see whether this is going to continue or not. But it is still rising. We're still it's sort of baked in for the next 2 quarters and probably even 3 quarters, where we're still seeing tax cuts sort of flowing through to companies. So they're still getting earnings growth from that. They're still getting earnings growth from the buybacks, so they're buying back lots of their shares, which increases their earnings per share growth. And there's and the US economic growth's quite strong. So there's still quite a lot of growth sort of baked into the numbers for the next little while. And so so it's, I guess the first point is when we see these numbers start to turn, that's when we'll need to be on high alert. Not saying we won't have these pullbacks, and maybe this pullback will push even a little bit further, but it's, to have a sustained pullback, it's highly unlikely to have one while earnings are rising rapidly.
Yep. Okay. Yep.
And so that's not true elsewhere around the world in terms of the growth rates. So this is largely US centric. Particularly Australia's growth rates are quite poor and going backwards. But this chart sort of still showing that your 12-month earnings are still headed up on a sort of 45-degree angle.
Yep.
Keeping that in mind, I'll just sort of jump to the next chart now. The 12-month forward earnings is sort of like a bit of it's a weighted average between 2018 and 2019 at the moment. So it's basically every day that goes past, it's a little bit less 2018 and a little bit more 2019.
Sure. Yep.
And so most of that increase is becoming not because we're seeing upgrades in either one of those numbers, but the forecasts for 2019 are staying where they are. And the forecasts for 2019 are sort of about 11-12% growth factored in. And so sort of as long as companies hold the line on that and keep coming back and saying, yes, we are going to get that 10-11% growth in 2019, then we'll keep seeing that number rising. I sort of suspect the 2020 numbers are probably a little bit optimistic, but we're a couple of months away from that starting to get included in those numbers. So,
Okay.
So for our part, for the US earnings, we still think we're not too concerned.
Okay.
If you look a little bit wider around the world, we've got a chart which I won't go into too much detail on it.
It's a great table, though.
Yeah, it's probably one for people to download the presentation or jump onto the webinar and have a look. So it's basically showing each of the areas around the world and the 12-month forward earnings over the last month and whether they've been upgraded or downgraded.
So the sectors and against the countries that they're in.
Yeah, sectors down one axis and countries across the other axis. And so you can see pretty much globally, Australia's a bit weak, Japan's been weak, but the rest of the world's been quite strong. We're still seeing upgrades, right around the world in terms of earnings. And so some of that's oil prices. So you can certainly see running right through that the oil price for all countries is played a big part. But even outside the oil, most of those other sectors are still seeing earnings upgrades.
Yeah, right. Okay.
Forward earnings.
Yep.
And then finally, it comes back to valuations. So valuations roughly about average. So I've got a chart up showing the 12-month forward EPS and the 12-month forward cash flow per share. So the darker blue line is the cash flow per share. So they're both certainly below. They're both certainly cheap compared to the last 4 or 5 years. Over the last sort of 10 to 15 years, they're about average.
Mm-hmm.
So sort of sitting in the middle of the cycle. One thing I would say though is that the numbers look better on an earnings basis than what they do on a cash basis. So from a cash flow perspective, it doesn't look quite as cheap as what it does on an earnings basis. Some of that's going to be the delayed effect of tax cuts, sort of flowing through a little bit later, but there is a divergence there that is at least it's got us at least watching for signs that you might see one of those. It's always good to see that the earnings are flowing through to cash. When you're seeing some strong earnings, but you're not getting the cash flow effects, often makes you more concerned about rises. And so it's just something we think there's a reason for it, but it's one thing we're keeping an eye on at the moment.
Okay. Yep. Sure thing. And then just finally, of course, my favourite part of all presentations is the portfolio positioning. So what have we got our eye on? What's been happening in the portfolios and where we're looking?
Yeah, sure. So look, it's worth just noting. So over the past month, just month to date, so there's been a bit of volatility. We've held a lot of cash, and we're holding this sort of barbell approach in terms of trying to mix the growth and stability to get the right mix, that we can still participate in the upside without giving away too much in the downside. And so far that's worked quite well. We're seeing that the Aussie market's down about a bit over 4%, 4.2, and sort of our Aussie portfolio is sort of down closer to 3%.
Okay, and so why the difference? Yeah, why the outperformance there?
Sector mix in terms of what we're in and what we're not.
Yep.
On the international side, so international markets are down also about sort of 4 to 4.5%. In Aussie dollar terms, though, so the Aussie dollars come into play there, and in Aussie dollar terms, you're down closer to 3.
Yep.
Our portfolio is down a little bit under 2%, so it's about 1.9.
Right.
And again, that's just a portfolio positioning in terms of trying to get those stocks that are enough stability, and then trying to get the growth sectors that we still think will hold up.
So essentially a combination of getting the sector selection right and then finding the quality stocks in those
sectors.
Okay,
yeah,
sure.
And it's interesting as well. Our performance in both in January was a little bit below market as we had this big blow off in the market,
Sure.
and then we picked up all the gains and plus a little bit more as the volatility hit in February.
Mm-hmm.
And we saw a little bit of that in the last month or two. Even though markets weren't that strong last month, it was actually some of the lower quality names that were holding up a little bit better.
Right.
And then as the volatility hit, they were the ones that sort of ended up down the most. And so we saw when the volatility hits is when you see the value and the quality performance come through.
Yep. Okay.
And then in the tactical portfolios, obviously they're holding a lot of cash, and so they're a lot less volatile. So the worst one is the growth down about 1.5%, sort of versus Aussie market down almost 4.5%, and income sort of down maybe 0.25% on performance. So the hedging of the keeping of cash and keeping that that ready and then deploying some of it has been working well. So having said that, though, we're not sort of boots in. We're still late in the cycle and still holding a lot of cash and bonds versus equities. We're still playing that two-stage, lots of staples and sort of safer stocks and some of the growth stocks where we do think there's still scope for them to participate in sort of late cycle. Having said that, it's always a matter of valuation. So as we see some of them get cheaper or more expensive, we tend to change that mix a bit. And whereas 2 or 3 months ago we were changing certainly more from growth into stability. As the volatility happened and we saw a lot of some of the high growth names fall the most, we're sort of at the margin we're sort of switching that around a little bit.
And just quickly there, you mentioned on valuations. I'll just I guess look back into Australia. So the I guess look, there's been a sort of pretty common theme of just reading out and about in the investment world on, say, dollar exposed industrials, healthcare, all these sort of stocks that we've been saying for a while being bid up because there's a lot of other areas that are the Amazon effect and all the rest of it are going to be putting pressure on the Australian market. Is that something that gets the sort of thing that gets reflected, say, in the US market? So do you find, say, we're looking at consumer staples, for example. People know that assets are fully priced. I guess obviously we're a bit of a cottage economy, so it's pretty easy to just pick out of a handful of sectors that make up the majority of the ASX 50 or 100. Is that something that happens in, say, the broader sort of more developed, bigger markets like the US, for example?
Yeah, and I guess the interesting stuff for the US market, given it is a lot bigger and there's a lot more companies sort of in that part is it just gives you more opportunities to play around. There's generally is a sector somewhere that's out of favour for whatever reason, or a company or two have come out with some bad results and the whole sector's been punished for it, and so that's what we spend a lot of time with the quant models doing, is to sort of just weighing up the value versus the quality side, and just as you're saying, okay, if I'm buying an average quality sector that was really cheap, and now it's an average quality sector that's not really cheap anymore, then it's tipping out of that and finding which of the sectors that are sort of drifting in and out.
Okay.
So yeah, certainly we have noticed there's a number of sectors that just sort of got overpriced on those, and that was as we said, we've liked the dollar exposed industrials in Australia for a long time. Having said that, they just got so expensive. We've been tipping out of those stocks, and some of those stocks were hit quite hard, even despite the Aussie dollar helping them, just because they were trading on such high multiples.
Okay. Sorry, go on. Yeah.
The other thing I just wanted to add in as well, in terms of hedging, so often what we find with people is you get to these points and you see the markets all of a sudden take a shake, and then they're like, oh, I've got a hedge. Often this is the worst time to be hedging.
Right.
So the volatility blows up, and so the cost of buying options and all that type of stuff gets significantly higher, and it's there's a question in terms of your hedging side of it, is saying if you're going to take a hedge across the entire cycle, so if you're going to say, yes, I'm going to always have this hedge sitting there, so I'll always be safe from these down parts. It's like buying a type of insurance, and you're going to penalise your performance by probably 1 or 2%, depending upon how much of a hedge you want. But you're basically locking in lower gains across the cycle, because over the cycle, you end up the same spot. It might have been with a hedge, your peak won't be as high and your trough won't be as low, but you are ending up at the same spot. The difference is with a hedge, you've just paid that hedge across the entire cycle. So for hedging, the important thing is to try and get it at the right points. And so for my part, it's saying, well, you need to work out don't rush out every time the market goes down and suddenly buy hedges, because you're probably paying up for them and buying the wrong point of the cycle but it's it's important in terms of if you are going to be buying hedges, in terms of saying it's a discipline, and it also needs to be something where you're either going to have those hedges on the entire cycle and take that sort of 2% hit to your performance, or you're going to say, well, tactically I'm going to put the hedges on, but I'm not going to put them on when the market falls. I'm going to put them on when the market's rising and volatility gets low and things like that.
And
have your plan,
sure.
In terms of that. And otherwise, if you go with the tactical side, we're sort of more comfortable with the tactical side in terms of picking up the cash in the bonds and using them as a using them because it's over the course of a cycle you don't pay that hedging cost the entire way through.
Okay, yeah, sure. Anything to add for our portfolio positioning, our chief strategist over here, David?
Oh, well, I've been giving quite a lot of thought to our hedges. We went through at MB. We went through a learning experience in 2016 when we picked a lot of the bulk commodity and Australian dollar weakness of 2015 and rode that down. And excuse me, some of the variables have fallen into place in the same way as they did at the end of 2015 now for a rebound in those things. And I'm talking about Chinese stimulus, and we are seeing some bulk commodity lifts. We have done for the last month or so, and that has the potential to also drive up the Aussie dollar and bond yields. So, excuse me, yes, bond yields. And so, our bond positioning and our Australian dollar positioning in terms of asset allocation are important hedges to us. So it's important to consider the possibility that those things, could run against us in the way that they did in early 2016. But although the market is very short the Australian dollar at this point, which is making it a little more difficult for it to fall, it's still very clear that the US is thoroughly decoupled from most of the global economy, that the Federal Reserve is still intent on raising interest rates, and we're going to see lots of deeper negative spreads to Australia. It's equally clear that although the Australian economy is at the tail end of a fiscal boom in infrastructure, as well as the tail end of its housing construction boom, and the labour market is still okay. We're equally the sort of leading, we're equally sort of departing from that boom, and the leading indicator of that is house prices. And although it's held up well so far because house prices haven't really hurt consumption and therefore tipped into unemployment yet, it's pretty clear that that's coming. And so there's still Buckley's chance of the RBA shifting rates up. In fact, we think the odds favour them cutting next year as house price falls in Sydney and Melbourne cross sort of 10% and develop into something of a confidence crisis. And so that means we're still quite comfortable with our bond hedges, Australian bonds, as well as the dollar. Despite the fact that some of those variables have swung behind a possible rebound in the bulk commodities. The other thing I will add is...
And sorry, before you go too much further, so we have picked positions in some of our stocks to offset some of that in case
we
that
have,
happens.
yeah. So we've picked up quite a lot of Rio recently and stuff, so we're also playing that rebound.
So you've hedged your hedges, essentially.
Well, kind of. But I mean, you can, because we think the Aussie dollar will remain weak. And so that actually represents an opportunity as well in the bulk commodity miners.
Absolutely.
Because their prices will be rising and the dollar will stay low, which is a very profitable circumstance.
It's actually been one of the best performers.
It has.
But it is that point about saying you can't put all your you can't play you can't load too hard up on one side of the ship. You need to make sure
that's
you've
exactly
got
right.
diversification and if things don't go, things will surprise you, and the expectation of where it's going to go is you need to make sure you're not all loaded up so that if things don't go exactly the way you expect, that your whole portfolio blows up.
Well, no, that's right. Well, that's a hedge fund, isn't it?
That's right.
Not an investment strategy.
So there's just one more thing to add to that, and that is that although bulk commodity prices are rising, it's a very different kind of price boom this time to what we've seen in the past, and it's not really an economic boom this time. There's the mechanisms by which rising commodity prices used to get distributed throughout the economy are all broken. What this is a mining profits and budget boom.
Okay.
And so, you used to see, investment flow on and some big rises in wages coming on the back of a lot of new jobs. That's gone, and it's been made even worse by mass immigration, of course. And on top of that, you used to get a lot of big share price rises. That's not happening because the housing bust is pulling the entire kind of housing half of the bourse down. And then the other component is the budget, and we will see tax cuts. So eventually some of this will filter through to households and domestic demand, but we've got an election coming first, and there's also a big debt stock.
So plenty of deleveraging perhaps before it starts to turn into consumption.
Well, there's more public deleveraging before they can really unleash tax cuts, and those tax cuts are going to hit private sector deleveraging anyway as house prices fall. And so, this is doing some marginal repair work to Australia's kind of overall debt to growth scenario, but it's not enough.
Okay, all right, very good. Well, on that note, to find out more about to learn a bit more about Nucleus Wealth, here we go. Looks like we had some technical difficulties there with our usual video, so I'll fix that one up in the after notes. But anyway, just a quick one now. As a big announcement, this week we've rolled out our personal superannuation option. So for those that have been following us and were interested in using their own personal super fund or money from their funds to do that, you can now do that through Nucleus Wealth and the MB Fund. A couple of things here, I guess. Well, firstly, if you want to check it out, head over to portal.nucleuswealth.com, make a login, and there's an onboarding system that we've put together. Shouldn't take more than about 10 minutes if you've got your wallet with you, and obviously your super fund details. You can select your ethics, so we've got 19 different ethical themes that you can choose from. We've also got a fee comparison tool from I think about 35 now of the biggest super funds. We've got a range of, we've loaded in the range of fees that you can expect to pay there, just if you wanted a hand in comparing with the fees for us. And of course, you can get some advice as well. So you can run through the risk profiling option, which will give you a recommendation of an appropriate portfolio for you, and we can go from there. So head on over to portal.nucleuswealth.com if you're looking to invest your superannuation. Coming up next week, same bat time, same bat channel, so Thursday the 25th of October, 12:30 p.m. Australian Eastern Daylight Savings Time, we have our topic, which we've called Quantopolis, Quantopocalypse.
So there's going to be an interesting just to listen to Tim.
Yeah, I know. I'd say that. And Damon's going to make sure it's on every slide as well, I'm sure, now. So we're going to be looking at, I think we touched on there with AQR, so a couple of the big quant funds, how they've been going, and some reasoning behind why they perhaps haven't been going so well. So we'll pull that apart, and I'm sure it'll be a very enjoyable listen if for the name only. And just finally, of course, we are available on Podcast Addict, iTunes, and wherever you get your quality podcasts from on the Android system. If you like what you hear there, please feel free to give us a review or some stars, and you can obviously it just helps us build the or get up the rankings and get in front of more people. So that'd be great and much appreciated. As always, thanks for your attendance today. Head over to bit.ly Nucleus Survey if you'd like to fill out our survey page. Gives you an opportunity to see or to give us some feedback on how we've gone today, maybe give some tips on how to pronounce next week's topic, and of course you can also drop in any further topics that you would like us to have a look at and present to you. So on that note, thanks very much for your attendance. I certainly got plenty out of it, and I hope it's helped give you some background into certainly the recent volatility that we've seen across world markets. We'll look forward to catching you at the next one. Cheers.